Hello guys, in this video we are going to discuss about unit 3 capital budgeting. It's very important topic. If anyone not yet subscribed our channel, kindly subscribe, bookmark. The objective of the unit is to understand the concept of time value in decision making. Time value means money as a time value. Based on time, that value of money will change. Next, discounting cash flow technique for investment appraiser. If you are going to make any investment, we can use this technique whether it's worth to invest or not. And one more technique is there for investment appraiser, internal rate of return. Money as a time value. For example, if you are having 100 rupees at right now at present, say after 5 years you are having 100 rupees. Is this 100 rupees at present is equal to 100 rupees after 5 years? No, because at 100 rupees what we are buying today, we can't able to buy the same goods at future after 5 years, because that prices of the goods will be increased. So today 100 rupees is not equal to after 5 years 100 rupees. So from this point it's clear that money has a time value. Today it has one value, after 5 years it has another value. For example, we are going to invest in a business, say 100 rupees. After a year we are getting 110 rupees. By seeing this we can able to think that 10 rupees profit, but we can't able to judge that 10 rupees profit like this. We have to convert this 110 rupees in present value. This 110 is what worth today. By converting this, if we get 99 rupees, 1 rupee loss, or if we get 101 rupee, 1 rupee profit. So by just seeing future value we can't be able to decide we are getting profit or loss. We have to convert the future value to present value, and then we have to compare the what we invested. So they given it's not sufficient to treat the money to be received in future, that our money we are going to get in future as having same value as the money to be received immediately. So they are saying that today present value and future present value is not equal. So we have to convert, either we have to convert present value to future value or future value to present value to a common reference point. Either we have to convert this 100 rupees to future value and then we have to compare with future. Else one more option is future value should be converted to present value, then we have to compare the two values. But in normal every place we are converting future value to present value, because the calculation will be efficient and it will be easy to judge as right now. So it is easier to think in terms of what the future cash flow are worth now. Thus using the present time, we are converting to present time as a common reference point. So present value formula is P equal to M divided by 1 plus R whole power N. So in annuity also we used present value, in bond also we used present value, in capital budgeting also we are using present value. In any case in accounting, if you are making any investment, we have to convert it to the present value so that we can able to compare either we get profit or loss. So this can be also written as M into 1 divided by 1 plus R whole power N. This 1 divided by 1 plus R whole power N is called discounting factor. So discounting factor is 1 divided by 1 plus r whole power n. Okay, discounting rate means r. This r is discounting rate. In exam, they may ask discounting rate in 0.5 mark and discounting factor in 1 mark. In book, they did not give separately what is discounting factor, but in exam, surely they will ask it. Okay, this one is discounting factor, and r is at rate we are going to discount, which is known as discounting rate. Okay, so for example, say we are going to invest 2000 rupees. So cash inflow we are going to invest. So minus 2000 from our hand. We are going to, our amount will be reduced to, so minus 2000. In first year we are going to get profit 350. In second year 500. Third year 600. Fourth year 800. Fifth year 800. Sixth year 800. So we have to convert this 350 in present value. This 500 in present value. 600 in present value. 800 in present value as of year. And 800 present value, 600 present value. So to convert this, we are going to use this formula. Let's see how we are going to do. So the main formula is m divided by 1 plus r whole power n. Here they choose r as a 10% as discounting factor. So first 350 rupees, m means cash flow. So 350 rupees we are going to get after 1 year. So we have here n will be 1 here. So 10% means we have to convert like this 0.1. So we are going to add plus 1 1.1 power 1. So 1.1 power 1, and then next 600 it will be second year. So 1.1 2, again 800 1.1 3, then 350, sorry I wrote wrongly. First 350 divided by 1.1 whole power 1 plus, and then 500 1.1 whole power 2 plus 600 1.1 whole power 3, then 800 fourth year. So 800 divided by 1.1 whole power 4 plus again 800 fifth year 1.1 power 5 plus 6th year 600 divided by 1.5 whole power 6. At last we have to minus this 2000, because profit means we are investing some amount. By reducing that amount only we can able to determine the profit amount. So we have to minus our investment value. So we have to calculate this one. So first 350 divided by 1.1, so 318.18 318.18, and then next 500 divided by 1.1 12, so plus 413.22 plus, and then next 600 divided by 1.3 divided by 1.123 450.78 plus, next 800 divided by 1.1 power 4, 800 divided by 1.1 1234, so 546.41 plus, next 800, so 800 divided by 1.1 12345, so 496.73 plus last 600, so 600 divided by 1.1 123456, so plus 338.68. At last we have to minus that 2000. So we have to add all these values. First 318.18 plus 413.22 plus 450.78 plus 546.41 plus 196.73 plus 338.68 equal to minus 2000. So if we convert all the future cash flow to present value, we get the profit of 564. So we get positive value, so we can invest the amount in this project. So this same calculation they explained in tabular column. So number of years 0, 1, 2, 3, 4, 5, 6, cash inflow, that M value they wrote for first year, second year, third, 4, 5, 6, and then this discounting factor, that means this 1 plus R whole power n, this value they mentioned here. 1.1 first one into 1.1 second, third, 4, 5, 6, like that they wrote here. And then finally they divide minus 2000 by 1, 350 divided by 1.1, 500 divided by 1.1, they find out the present value. So here present value 318, 318, 413, 413, 450, 450, like similarly 546, 496, 388. We can find out by using tabular method also. I will teach you a shortcut without using anything, any paper pen. You can able to solve this one by using only calculator itself. So first what we are going to 350 divided by, first we are going to find 10% means 0.1 and denominator plus 1. So in denominator we have to substitute 1.1. So 350 divided by 1.1. So 318 for first year. So 318 for first year memory plus. Then 500 divided by 1.1 second year. So 1, 2. So second year value memory plus, and then 600 divided by 1.1. 1, 2, 3, 450. So memory plus, and then 800 divided by 1.1. 1, 2, 3, 4, 546 memory plus, and then 800 divided by 1.1. 1, 2, 3, 4, 5, 496 memory plus, and then 600 divided by 1.1. 1, 2, 3, 4, 5, 6, 338.68 memory plus, then MRC. So we get total value by adding all this, then minus 2000 we get 564. So by using this calculator without using any paper pen, we can able to solve within a minute. Okay, so we get a positive value, so we can invest in this project. Suppose if we get minus 50 or minus 100, it's loss. So we no need to invest in this business. To invest in any business or anything, we can able to use this technique. It's whether worth to invest or not. Next, present value tables. So if you are having computer calculator, we can able to solve easily by using calculator. Before the invention of computer and calculator, it's very difficult to solve these values in mathematically. For example, here 1 divided by 1.1 whole power 6 means by calculating this one will be tedious process. For that purpose, they provide a table to calculate the present value. So however, in absence of such device, before invention of computer and programmable calculator, discounting table are used. First table is for present value in general case. This one present value of annuity. So as I said, discounting factor is equal to 1 divided by 1 plus R whole power n. Here they give t, they use different notation, but basic concept is same. So here discounting rate is 1%. The values are given are for 1 rupee. Discounting rate is 1%. After 10 years, that after 10 years means it will be worth 0.905. After 10 years, 1 rupee value, if we convert to the present value, today's worth is 0.905. So we can check whether it is right or not. 1% means 1 divided by 100 plus 1. Denominator 1.01. So 1 rupee. 1 divided by 1.01. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 0.905 here, 0.905. So this table is provided only for the purpose if calculator and computer is not there, we can use. But in the exam point of view, we no need to take these things in matter, because in exam we can carry the calculator, and one more thing, they won't provide you this table. So this is only for our understanding purpose. Next one, so here we said discounted cash flow technique for investment appraiser. So discounted cash flow technique for investment appraiser. Totally there are two methods. One is net present value, and one more thing is internal rate of return, IRR method. To use these two methods, two things we have to assume. First one, that future, we said now future we are going to get for 350, 500, 600. This should be an fixed. After 5 years, this 600 may be received or may not receive, but in assumption we have to consider 600 rupees we are going to receive, we are going to get. Then there is no inflation. If we assume these two things, this method is super method for calculating. So in actually this is an NPV method. So net present value means present, these are present value. So we are adding all these, we are going to get a net amount. It is called net present value. So how to find net present value? They given as steps. First, estimate all future net cash flow. Okay. So same example they given. Last same example 338, 564, 564. Same example they given. What they are saying is estimate all future net cash flow associated with an investment opportunity. All cash flow. Okay, estimate all cash flow. Then convert these cash flow to present value. Convert these cash flow into present value equivalent by discounting at appropriate discounting rate. Here 10% is discounting rate. Then add all the present value. Subtract from this value initial cost of investment. By adding all these, we have to minus 2000. We get net present value. They given this formula. It's nothing but this one. So this one is C1, C2, C3, C4, C5 up to n times C6 minus I means initial investment. Here I is initial investment, R is appropriate discount rate. If NPV is negative, we won't choose that project. Okay, they given an example. Consider they are going to manufacture toys. They are having two options. Either they need to set a new factory, or they have to use an old one. That old factory is ideal, so they want to renovate the old factory. They have two options. One, they need to construct a new factory, or else they have to renovate the old one. By in which one they will get the highest profit. If they construct a new factory, initial investment will be more, and then following years the profit will be increased, because that maintenance cost and running cost will be somewhat low. If the plant is renovated, initial investment will be low, but the profit we are getting will be reduced because maintenance and running cost will be high. So this table we already solved 564. So let me calculate this one by using our shortcut. So 200 divided by same 1.1 10%, so divided by 1.1, 1 time memory plus, and then 260 divided by 1.1, 1 2 memory plus, and then 450 divided by 1.1, 1 2 3 memory plus, 700 divided by 1.1, 1 2 3 4 memory plus, 700 by 50 divided by 1.1, 1 2 3 4 5 memory plus, then 400 divided by 1.1, 1 2 3 4 5 6 memory plus, MRC 1873. Our initial investment is 1500, so minus 1500 we get 373.3. so 373.3. So if we choose project A, our profit will be 564. If we choose project B, our profit will be 373. So in project A we are going to get highest return, so we can choose project A. This is net present value. This value is called net present value. In question they may ask what is net present value. Okay. In next video we can see internal rate of return. Thank you for watching video. If anyone not yet subscribed our channel, kindly subscribe, bookmark.